Like to say this. People think they're passive investors. I'm telling you, don't be a passive investor. You need to be an active passive investor. Your part of the job is to A, understand the market, and B, understand how the syndicator you're working with is adapting to it. So be an expert in those two things. Understand the marketplace, really
Hmm.
understand what's going on, and understand what your syndicator is doing to adapt to it.
So I have a not a stranger to the Practical Wealth Show. So after Mr. Neal Bawa on probably your third or fourth time on the show,
Third
and
time,
he's a
yeah.
affectionately known as the mad scientist of multifamily. Okay, and he also serves as the CEO of Multifamily U and Apartment Investing Education Company. He's a top-rated speaker at conferences and events across the country, and nearly 5,000 students attend uh, his seminar series each year. So what I love about Neal, he thinks macroeconomically. He's really creative in making money happen. And so let's without further ado, Neal, let's talk. Welcome back to the Practical Wealth Show, sir.
Thanks for having me back. It's a very interesting time to be talking about all things real estate and multifamily, and also macroeconomics. There's a lot going on.
Yes, and we want to hear it from the man.
Well, my perspective really is that we are at a fundamental shift, and this shift is that world governments are recognizing that this phase that we've had, this very quiet phase of low inflation has really ended, and they're
Hmm.
all trying to understand what that means for the future. I think the future is not a high inflation, but a medium inflation future, and we've all got to adapt to it in lots of different ways. Real estate is struggling to adapt to it, and we've got challenges coming up. One of the things that's coming up is that um, we know that there's 1.5 trillion, that's 1,500 billion dollars worth of commercial real estate loans that are going to be maturing in the next 12 to 18 months.
Mm.
And commercial real estate, by the way, doesn't include apartments. So it's apartments and then commercial real estate. So, stuff like office and hotels and strip malls and, any kind of retail, self-storage, those kinds of, areas. They have these loans coming up for renewal, Curtis, and it seems like nobody wants to renew them because the value of all these assets has dropped, or
Hmm.
most of these assets has dropped, especially in the office side.
Hmm.
Retail, maybe a little less. Other asset classes like storage and industrial have not seen as much of a drop. But as these assets have dropped, nobody wants to renew them and the loans. And the big reason for that is simply this: it's Silicon Valley Bank. So
Mm.
what SVB did is that it took a bunch of money that the small to mid-sized banks had and moved that money to these super too big to fail, super large too big to fail banks. So banks like Wells Fargo and JP Morgan Chase saw massive deposits because there were lenders, people like me, that were sort of fleeing to those areas,
Hmm.
and the small banks saw massive loss in deposits. At the same time, because of what happened at SVB, where they basically did a bunch of things that they shouldn't have done, the
Hmm.
Federal Reserve is now ordering mid-sized banks to do full reviews of their balance sheet, look at the loans that they're handing out, and do what is known as mark to market. Mark
Hmm.
to market is a process where you say, okay, well, when I gave this property a loan, its value was 20 million, the loan amount was 12 million. Well, now what you're saying is this property was 20 million then, but today it's only worth 15 million, right?
Mm.
And so
Hmm.
my loan is still $12 million, but because the property is only worth 15 at a 70% LTV, my loan's only worth 10.5 million. It's not worth 12. So I'm marking down the value of my loan from $12 million to 10.5. Well, that's bad because as the banks mark down the values of their assets, it reduces the amount of money that they can lend, right? In
Uh-huh.
addition,
Hmm.
they've lost massive amounts of deposits to the big bank. That also reduces their ability to lend. So now it's a double whammy. On the existing assets, they have to mark down the value. On the assets that they don't have anymore, they can't lend on that. Remember, banks, if you give them a buck, they can lend out a buck, right?
Right.
And that is called fractional lending. So when all this money has left the banks, and all of this stuff has just happened, Curtis. It's happened in the last 43 days,
Wow.
essentially, right?
Yeah.
So, or 47 days. So in the last 47 days, thousands of banks in the US that were mid-size have lost these deposits. Now, what's interesting is that 40% of all office financing in the US was coming from these small to mid-sized banks, 38% for retail, 30% for industrial. Now, apartments were only 19%, and I'll explain why in just a moment.
Okay.
It's not inconsequential, by the way, 19% still a hit for apartments. But the reason why apartments are different from all other forms of commercial real estate is that there's a federal mandate to provide loans to apartments. There's no federal mandate to provide loans to offices or retail or hotels, right? The
Right.
market basically does that. The market provides those loans. But there are two organizations, Fannie Mae and Freddie Mac, whose job it is to inject capital, inject debt into the multifamily space, and each of them has huge amounts of money, 70 billion, 80 billion a year to do loans. So that
Hmm.
market is completely liquid, even though the interest rates have gone up. And that's why with apartments, you never really see a year where more than 20% of apartment debt has come from small to mid-sized banks. Currently, the number is 19%. But office, over 40%, right? Retail in the high
Right.
30s, industrial in the low 30s. Well, all of these areas are going to have severe problems in the next 18 months getting any kind of refinancing.
Let me
So
ask you a
I
question
think,
right there
yeah.
on that part. I just want to bring this out for people. So the reason why the commercial loans are lower, is it because the revenue is lower because the people are not, they have empty offices?
Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
Because
That
commercial
correct.
real,
So,
okay.
it's really what's happening is, on the office side, we are about to see an incredible once in a lifetime meltdown, right? We're
Mm,
going to see office values fall by a catastrophic amount because something fundamental has changed. People like to say for multifamily, Curtis, they say things like people still need a place to live somewhere, right? So
right,
that
right,
what they're saying is the fundamentals of apartments haven't changed. All that's changed
right.
is interest rates, which reduces the amount of cash flow, right? But the fundamentals of office have changed in a catastrophic fashion because of COVID. Most companies that are urging their employees to come back to the office are saying you can come back to the office 3 days a week. Now you might say, yeah, but they still need the same amount of office space. That's not true anymore. Almost every major company that is allowing people to have 2 days off a week and work from home and 3 days in the office are switching to a matrix model where no one has a desk. You basically have a shared desk. And what they do is they tell people, okay, Curtis, you take Monday and Friday off. And Neal, you take Tuesday and Thursday off. And now
Hmm.
their needs for office space have shrunk by
Right.
20 to 30%, right? So same number, smaller number of desks, same number of people using them. And then there's companies that have not returned. So 10 to 15% of companies have simply said, we think we can just be an off-site company,
Mhm.
a lot of this is small to mid-sized companies. But keep in mind that America has a million small to mid-sized
Yeah.
companies. So we're
Yeah.
talking about tens of millions of employees
I'm
that
seeing
simply
that
are
in the
not returning
insurance
back.
industry. Yeah, in my industry, in the
Right.
insurance industry with the home offices, they still have underwriters or work from home, and they're kind of doing what you're talking about. And some of them are still shorthanded, but it's I'm seeing that where they had this huge office space, everybody came in. Now you'll call the home office. I can tell they're work from home,
That's
sometime.
right. That's right.
And
So
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 the
you
world has
have
changed, shifted. Yeah, fundamentally.
it's a catastrophic change.
Hmm.
Office is $1 trillion business. Once again, Office is $1 trillion business, and
Hmm.
all of it is unviable at this point. The entire premise of offices was built on occupancy being in the high 80s, right?
Hmm.
Well, there's nothing in the United States, no city at high 80s. Everything is below break even point, and then San Francisco is just a complete debacle because it's in the low 70s. So there's going to be not hundreds of millions, but hundreds of billions of dollars of office buildings that are going back to the banks in the next 2.5 years. So we're going to see that, and some of it will have a negative impact on apartment, but actually there's going to be a positive impact. So office landlords always used to look down upon multifamily. Oh, your average tenant only has $400 in the bank, and you have to get new tenants every 2 years, and you have to deal with gunshots and dog bites and all these other kinds of things. And we deal with companies that have tens of millions of dollars in the bank, and they sign 5 to 10 year leases. We're like one level above you guys.
Hmm.
Today,
Hmm.
every office landlord, every $1 billion office company, they want to buy multifamily. They do not want
Right.
to buy office. They do not want to have anything to do with office. So fundamentally, the demand for multifamily has increased. Is that going to help us in the short term? Probably not, because in the short term, there's a lot of people. There's a huge amount of capital that is not being deployed into multifamily simply because the numbers don't work because of interest rates. So there's an incredible amount of capital in the trillions that is sitting on the sidelines and continues to sit on the sideline, including me, by the way. We started underwriting multifamily properties on April 1st. We're recording this midway through April. We just made our
Hmm.
first offer. We got into best and final yesterday on a property in Florida. So we've been sitting doing nothing for the last 9 months because we could not make numbers work. But the
Okay.
demand is incredible. So when the numbers do work, and we can talk about when I think the numbers are going to work,
Yeah.
I think that there's going to be a tremendous increase in interest in multifamily, and that'll hold the prices where they have. They've dropped 22%. So from peak, multifamily prices are down 22%. Some markets are as little as 14, 15%, and then Phoenix is like at 27%, right? So markets are all over the place, but on a nationwide basis, cap rates have changed by 26%, 22%, which is a huge discount, right? I'm
Right.
looking at this going, why are investors scared? Every investor loves to tell other people. Everyone loves to quote Warren Buffett, which is, when other people are greedy, you should be fearful. When other people are fearful, be greedy. Well,
Right.
clearly other people are fearful right now. Why aren't you greedy? The price is down 22%. Net
Hmm.
operating income is the same. Everyone loves to lecture people on multifamily is a business. Well, if the business's income remains the same, and the price you're paying for it changes by 22%, you have a once in a lifetime opportunity, right? But there's
To grow, it's
investors who are
opportunity,
like,
right? To go buy some stuff if you can get the money.
exactly. It's like,
Yeah.
I'm waiting for a better price. Well,
Yeah.
if you have a 22% better price compared to 13 months ago,
Yeah.
you should be buying everything in the marketplace, right? Oh, no, no, because interest rates are very high. Well, interest rates go up and they go down. But if
Right.
you lock in a 22% price discount, it's yours forever.
Right.
It's yours until the day you sell this property.
Right.
That is a critical differentiation that people like us who are numbers driven. I'm a mad scientist. My job is to look at numbers, and I look at
Right.
the math and go, when I wasn't buying 24 months ago, a lot of my investors left. They left me. They went to other syndicators because they were buying a property every quarter, and I was buying absolutely nothing. And now they're not investing with me because they've had a bad time with those syndicators with the cash calls and the, oh my god, I might lose all of my money. And so I feel like I'm not really getting rewarded for sitting out in the last 24 months because
Right.
my investors are basically taking their bad experiences with my colleagues who went out and bought a bunch of properties, and on the basis of that, they don't want to invest with me today. So it's a sort of a strange situation, and I'm dealing
Right.
with it as best as I can.
Tell me about how important is it? Because what I try to do and what I'm trying to get our clients to do is think from a macroeconomic standpoint, like look at the big picture and then niche down. What people do is they start small and then go smaller, like go from micro to go to micro below that. But I think you see the forest through the trees because you see the whole, you look at the economy from the way I hear you talk about stuff. And then that kind of drives your decision. That drove your decision to not buy anything because you understand interest rates, macroeconomics, and so you see the opportunity because you're thinking it bigger. How should they be thinking, or how can they learn to train themselves to think like that? And then what do you see going forward?
I love podcasts. I appear on podcasts twice a week, 100 podcasts a year.
Wow.
And I think they're very useful because they're a very convenient way of learning, right? But I would encourage people that you get data from podcasts. It teaches you a great deal, but you also need to get data from folks that are afraid to get it wrong, folks that are paid to collect data.
Yeah.
So I would encourage all of you who are interested in commercial real estate to sign up for the following newsletter. So I'll just give you a list, right? So a website that I really like to go to is called globest.com. ST stands for street. So globest.com. And Globe Street publishes data on the multifamily and real estate marketplace, and you learn a lot. For example, I'm looking at you right now, Curtis, but on the right side, I've got the Globe Street website up. So just on the homepage, deal activity shrank 56% in Q1 as cap rates rose 30 basis points. Rising office fit out costs are leaving projects on shaking grounds. Big banks say debt ceiling limit could hit by mid-June. Life insurance lenders are not going to provide a lifeline for office owners. That's just the first 4 articles today on this website. Can you imagine how much you would learn if you went to this website once a week?
Right.
Yep. So to me, it's really important to take what you're learning from podcasts, which is easy to digest, chunk by chunk information, and then pair that up with experts in the industry that are writing articles on websites like globest.com. I subscribe to the Marcus and Millichap newsletter. I subscribe and I go to their webinars. I subscribe to the Yardi Matrix webinars. Absolutely phenomenal, great understanding of the industry. I subscribe to the CBRE newsletter. These are people that are selling hundreds of billions of dollars of real estate every year. And when you sell hundreds of billions of dollars of real estate, it gives you a viewpoint that we can't have, right? Because it's like they're seeing thousands of different multifamilies move in 50 states.
Right.
And that gives them a perspective, this 35,000 square, foot perspective. They're not charging any money for these. All of their webinars are free. All of their newsletters are free. So it's really about educating yourself. These are the people that understand macroeconomics. They teach me macroeconomics. They say things like, when interest rates go above this level, cap rates can never stay above this level, they or below this level, they have to go up, things like that, right? So I learn a lot about this, and I also learn a lot about the trends that are going on. So I think the feedback is investors, even though they love to quote Warren Buffett, are terrified when bad things happen, and the way to become unterrified is to empower yourself with data from high quality sources. And when you do that, you realize, oh my God, this is a terrific time to buy. But no one seems to be saying that because no one seems to be able to explain why this is a terrific time to buy. 22% price discounts with no change in income. Wow. Yes, interest rates. Yes, you're going to suffer in the first year because your cash flow is going to be close to zero. My point though is all that's happened is you got a 22% discount on a property where 1% of that, maybe 2% of that was your cash flow. So let's just knock down that 22% to 20 because you lost 2% in cash flow, right? You still got a 20% discount. That is huge. And a lot of people are like, 20% doesn't seem like much. You realize that if the value of a property increases by 40%, you're going to double your money. Why? Because you use lending. On a $10 million property, there's $7 million of lending and $3 million of equity. Therefore, if that property goes from 10 to, let's say, 14, haven't you doubled your money? Because the loan's still the same amount.
Yeah.
So a 40% increase in property value is usually a doubling of investor equity. Yes?
Yes.
Well, if you can get 20 out of that 40 when you're buying, it makes it so much easier to do the other 20. Everything starts to make sense.
That makes, Neal, one of the things we teach our clients is that, investing, well, we say investing is a plan. So you got to have a game plan. But the 3 rules of investing that we teach are invest in what you know, or invest in knowing, right? Invest in if they're smaller, invest in what you could control or influence the outcome of. But I will go back up to the first one, invest in what you know, or invest in vetting good operators, right?
Yep.
Is if you're syndicating, and don't chase returns. See, so people are chasing returns and they don't have what I call money rules, like fundamentals, or they're not work with somebody that has money rules of looking at the world like what you're talking about. And I think that that's key. I think you need to educate yourself so that even if you're a you want to invest in syndications, I don't think you should not know anything. That's just like putting money in your 401k, but you don't know what fund you're in, who manages the fund, what stocks are in it. I mean, you're supposed to lose money. And because you don't know what you're doing. You're just gambling. You're hoping. Hope is not a good strategy.
I'd like to say this. People think they're passive investors. I'm telling you, don't be a passive investor. You need to be an active passive investor. An active passive investor. Your part of the job is to A, understand the market, and B, understand how the syndicator you're working with is adapting to it. Those 2 things you need to be an expert in, so you don't need to know anything else about anything else. So be an expert in those 2 things. Understand the marketplace, really understand what's going on, and understand what your syndicator is doing to adapt to it. Be an expert in those 2 things, so be an active passive investor.
I love that, And what should so give us the good news, or like what you see, because if there's opportunity, right? And so what are you seeing? What's the time frame? And what should they be? Well, let's do that part. I want to get into what they should be learning and how they're going to learn it. So I want you to talk about Multifamily U, but or if they want to do it, right? And then if they want to just not want to become the investor, then how can they invest with you? I want you to talk about that.
So first I'll start with the good news. Number 1, it's clear to me that inflation is down. And I look at forward-looking data. I go to a website called Freight OS. That's freight followed by the words os.com. And I look at shipping container costs from China to the United States, because that is an indicator of demand and supply. Shipping container costs today are cheaper than they were in 2019, even when adjusted for inflation, right? Even if I don't adjust for inflation, they're still cheaper, which is crazy. So they're basically down 20% because there's 20% inflation in the last 3 years. That shows me that demand is down. When demand is down, inflation cannot be high. So expect inflation to continue falling. Another component of inflation has been rents. Rents are a big part of inflation, and rents have been high. They've been crazy. But for the last 12 months in the United States, rents have dropped by 0.4%. Flat. No growth, no decline. They're flat. When rents are flat, inflation has to fall. So because rents are perhaps the biggest component of inflation. So we are clearly seeing inflation move in the right direction, and that is buying the Federal Reserve time to not raise rates aggressively, to start cutting them later in the year. So I think that there's normalization. We've been through a very painful cycle, and there's definitely light at the end of this tunnel. This is why I am timing all of my properties now. I am looking to buy them at this point of time in the next 6 months. I want to stay in contract as late as possible, because I believe what is going to happen is later in the year, as we go into a recession, which in my mind is guaranteed, we will see the Federal Reserve start to cut rates. Maybe they cut in September, maybe they wait until October. But the moment they cut rates, we should see much lower mortgage rates. And so At that point, though, if you're not in contract, sellers will know that rates are going down. They'll start hiking up their prices. So you have an opportunity, a window of opportunity between now, April, and October to put properties in contract and not close them. Don't buy those properties. Put them in contract. Stay in contract. Remember, with multifamily properties, you can stay in contract as much as 5, 6 months, and you can really drag it out, right?
Okay.
We want to drag it out. We want to drag it out as much as possible. And the more we drag it out, the better for us. For every quarter point decrease in interest rate, you are creating hundreds of thousands of dollars of profits. For a 1 point increase in interest rate, you're getting the best of both worlds. You're getting that huge price discount up to 22%, but you're also getting lower interest rates as they go down. So right now, my message for people is get properties into contract and don't close them.
Okay. I love that strategy.
Right. And I'll answer the last part.
Yeah.
Most people are interested in learning more about multifamily or just real estate in particular and macroeconomics, which is something I do a lot of events on. Can go to multifamily, the word multifamily followed by the letter U, so multifamilyu.com. 25,000 people sign up for our webinars, and they're about macroeconomics, deglobalization, what's happening with real estate, what's happening in commercial real estate, single family real estate, and multifamily real estate. And we do, a dozen webinars a year, and on average 2,500 people will sign up for each of our webinars, and we take a lot of data from these 30 or 40 different sources, and we put it in bite-sized chunks in front of you so you can learn faster.
I need to know that. It's funny. I am so this is personal for me, but I'm thinking, like, I always tell people I want to invest in what I know, which is my business, so I can make my business grow faster. But then I heard Kiyosaki say one time, the purpose of business is to buy real estate. So now it's like, all right, do I want to go to Multifamily U and learn how to buy one or buy them, or do I just want it, Neal, here's 100,000, make me some money. And or a combination of both.
Yeah, I would not agree with Kiyosaki on some of these things. I would say you should continue to be active and buy some real estate that you have control over.
Yeah.
And then you should invest with other people. These are two different strategies. They both have benefits depending upon how good the syndicators that you find. I find that most people eventually end up investing most of their capital with other people once they have trust. But you shouldn't do that at the beginning. If you want to invest your money with other people, you want to do that over a very slow period of time. I wouldn't even say 5 years, over 10 years. Establish trust. Let them sell multiple properties. Let them make money for you multiple times. Investing with people like me should always be a part of your strategy, but never the entire strategy. Because when you're doing that, you're just dependent on other people to make money for you. Be an active, passive investor.
That is so powerful. I'm gonna make that a snip we put out there, because that's so good. Because that's great advice, great wisdom, clarity. Because I wasn't sure how I felt about that. A lot of people I run into, they're good at their thing and they don't want to give it to somebody else. But then I see people now, they're okay. Well, I'm willing to not do all this stuff, and I've got some capital. But I think it's wise. Like, even as I think about it, for me, I should know how to do this, and then I can see doing both. I can see the wisdom and always make my business the driver, but I need to diversify where the money comes from. So I think that's brilliant. So Multifamily U, if you want to learn how to, just learn about the market. I had a couple of I have to find them again, but I had a couple of I didn't know they were students till I had Ann on, and I said, "Oh yeah, so are our students," and they had just closed on a 140 unit property, and they did. So their thing works, because I've interviewed some people that have gone through Multifamily U that are doing the thing, which is started down in two brothers from Cameroon who are down in Maryland that I have to reach out and see how they're doing, right? And tell us about that you have more macroeconomic things, grow Capitus, and what you're doing with that, and why should they, want to follow you there also?
So Grow Capitus takes the macroeconomics and makes investments. So we do that on two bases. One is I look at macroeconomics and I post the data on a website called udemy.com. All my data is free, by the way. So udemy.com. So you can just simply type in Udemy, the word Udemy space Neal Bawa, and you'll notice that right now there's 11,000 nerdy people taking a very simple 90-minute data science course. And that course basically explains what we do and how it has benefited us in the past. Okay, what is our process? What's our system? By the way, you can take it and do it yourself. You don't need to, it's we internally we improve it because we can afford to pay for paid data. But still, 80% of what our system is available for free. The course is free, and the data that we use in the course is also free. So you can do it yourself, and I do recommend that you get into that. So on the one side, we use that data, and that tells us where in the United States to buy and when. A lot of people are like, Phoenix is doing well. Yes, but too many people know that. You should have known that 24 months ago or 36 months ago for you to be a beneficiary. Knowing that a city is doing well does you no good at all, because you're last one in. And all that's happening is there's a bunch of other people that know that Phoenix is good at this point in time, and they're driving up the price for you and everyone else. And so you're last one in. Last one in is a sucker. Right? So you've got to know where the next city is, which means that you've got to catch them on their upswell, not while they're at the top. So I can tell you, I've invested in Phoenix, but Phoenix may not be the best place to invest in today. It's a great market, but it doesn't have the momentum today that it did 24 months ago. So we try and find out the momentum, and we try and invest in those properties. When we do that, we see huge returns. I mean, look at our website. It'll tell you the story. We are very transparent. We just tell you which properties made how much money. That information is auditable. We're absolutely and completely transparent with our successes and failures. So check those out at growcapitus.com, GROCAPITUS.com, and it'll give you more information about what we do and how we do it.
All right, that's awesome. I was going to go back so you can go to Udemy. You can follow this stuff. See, I love that he's giving you all these places where you can learn to learn, right? And learn to read. The numbers tell the story, what's going on. I had a mentor tell me, Neal, if you know what's going on, you'll know what to do.
Yes.
And
yes.
Right. Most people don't know what's going on. And then I think that you should, just like put it up on your wall. Be an active, passive investor. I might print that out and put that on the wall next to Carpe Diem. Seize a day, but be a passive, active investor. I think that is absolutely brilliant. Neal, anything I didn't ask you as we close? I know you have to do a bunch of these that I should ask you, or I didn't ask you that you want to get out, in this talk.
This is not the right time to be fearful. You're going to miss a lot of opportunities. All of you said to yourself, and you promised yourself, that if there was a situation like 2008 or 2009 again, you wouldn't do what you did in 2008 and 2009, because you would go to every cocktail party and they would tell you how real estate was horrible. And we now know that if you were buying real estate in 2009, you have made an enormously large amount of money, right?
Yep.
Why? Because it was down. But the news was all bad. Well, today the news is all bad about real estate. And it's down. It's not down 40% like 2009. It's down 22%. But that's still an enormous amount of money. So train yourself to understand the math. This is not the time to be fearful.
I love that. Is that specifically to the multifamily, or would you look at smaller or like 2 to 4 units, the same boat, or are we talking about multifamily?
I would not make that comment for anything that's 1, 2, 3, or 4 units, because the price, that is called the single family market up to 4 units.
Yeah.
And the prices there have only dropped by 5%. You might say, why such a huge difference? The answer is debt. So 99% of everything that was purchased in the United States before interest rates rose was 30-year fixed debt. People haven't felt the need to get rid of it. Rents are high. Single family rents are actually doing even better than multifamily. They are growing. So multifamily rents are flat. Single family rents are at 5%. So those landlords haven't felt a need to sell their properties. They're just sitting on them. So I don't think that there's an opportunity in the 1 to 4 unit at this point in time, because there's no distress, there's no pain, there's no one screaming and saying, buy my property. 5%, I think, is too small of a number to get excited about.
I love what you said. That's a great distinction. I'm glad you pulled that out, because now I want you to know why you might need to learn this stuff, because it's a little more complicated. I don't, but that's good, because that means you have less competition of people that actually want to work and how to learn stuff. So you have to go where people aren't. Okay. And go where the people aren't. So majority is usually wrong. So listen to the majority, and go where the opportunity is and be aggressive, is what I'm hearing.
Today it's time to be aggressive.
Time to be aggressive.
I've been sitting on the sidelines for a while, but I know that my window of opportunity will close within the next 9 months.
Okay. All right. That sounds good. Neal, thank you for coming back on the Practical Wealth Show. Always dropping gems. And I think this is very actionable stuff. So I hope you're hearing this when the show drops, probably next week, and go out and, go learn some stuff, or go check out, hey, maybe I don't feel like learning all this stuff, but Neal knows this stuff, and I'm going to give him, to develop a relationship. One of those two, or both. Right?